Germany is very precise on becoming climate neutral by 2045. This for us is not a threat. This is part of the DNA of our investment program, because by doing energetic modernization, we are generating an IRR of 10%.
I'm here today with Philip Grosse, CFO of Vonovia. Philip, thanks so much for joining us.
Thanks for having me here.
As a residential real estate company with a portfolio covering Germany, Austria, and Sweden, what are some of the main themes or trends you see in your key markets today?
Yeah, there are basically three of them. First, Germany in particular is very undersupplied. We have roughly the need for 400,000 to 500,000 units annually, in particular in the metropolitan areas in which our portfolio is present. But the current run rate is only 200,000. So that obviously is putting a lot of pressure on rents, which is a good thing for us in a cynical way. Second is investment program. Germany is very precise on becoming climate neutral by 2045. This for us is not a threat. This is part of the DNA of our investment program, because by doing energetic modernization, we are generating an IRR of 10%. And that again is helping tremendously our rental development. And that moves me to point three, and that is the big discrepancy between our regulated in-place rents and market rents. Market rents are twice as high compared to our regulated in-place rents. And with the dynamics I was describing and the regulation in place, we are able to grow our rents annually by 4.5%. But given that reversionary potential of 100%, we have that very long-term visibility on stable rental growth year by year by year.
And is there an aspect of your latest earnings report that you feel underscores your goals or priorities at this point?
Essentially, it's the total shareholder return our business is producing. Our stock is currently trading at a steep discount of roughly 35% to EPRA NTA. And that means that 13% is essentially fueled by two constituencies. One is growth in cash earnings. It's that rental growth trajectory I was describing, 4.5%. On top, we are also active in various non-rental segments. They're growing with a CAGR of even almost 30%. And that is positively impacting cash earnings, which net of tax and net of still increasing interest expenses is still translating into mid-single digit EBITDA growth. Second is that this rental growth will also do something to the development of our portfolio values. Stable yields, rental increases will translate into value uplift. And those two constituencies are adding up to that 13% of total shareholder return. A third of that is paid as a cash dividend. 2/3 is increasing essentially the accounted equity value.
And in your meetings with investors this week, is there a key strategic theme that you're focusing on?
Yeah, we are coming out of a time where we had to manage the crisis and stabilize, in particular, the capital structure, keep the rating, the BBB+ rating. I think that has stopped. People recognize that values have found its trough, and that from now on we will see gradually increasing values again. And against that backdrop, it's a lot on growth. I was saying before that our business is a very regulated business, that the top line growth for our rental segment, because of the regulation, has a cap on growth of 4.5%. So the focus really is on the non-rental segments where we want to grow with a CAGR of close to 30%. And that is fueled by a lot of initiatives we have put in place. Part of that is what we have done also in the past, but put on hold during the crisis. It's our unit-by-unit privatization business. It's our development-to-sell business. It's scaling up the investments, which is benefiting our craftsman organization. There are, however, also a number of new initiatives where we want to expand on our B2C and B2B business, which is adding up to that 30% CAGR on growth in non-rental segments. And that is key discussion point with investors, which is nice. It's not about stabilization, it's about growth and future again, which is a nice shift in mindset.